The current live price for Opendoor Technologies, ticker symbol OPEN, is $5.51, representing an intraday climb of 5.56% as of this Monday afternoon, April 27, 2026. While most of the market is fixated on the broader recovery of residential real estate, there is a specific data point from the last hour of trading that should grab your attention immediately. While retail volume is steady, we are seeing a massive spike in block trades at the $5.45 level, suggesting that institutional players are quietly absorbing inventory before the next volatility window. This isn't just about people buying homes again, it is about the smart money betting that Opendoor's cost-cutting measures have finally aligned with a more predictable housing turnover rate. The common expectation among most people looking for investment help is that Opendoor is a high-stakes gamble on interest rates. The narrative is simple. If rates stay high, Opendoor dies. If rates drop, Opendoor flies. But the reality is far more complex. While you are watching the Fed, Opendoor fundamentally restructured how it values homes. They are no longer just an iBuyer flipping houses. They are becoming a logistics and data company that happens to own real estate. By shifting towards an asset-light model and partnering with major home builders, they've reduced their risk of holding toxic inventory during a downturn. If you're using Robinhood or SoFi Invest to track this, you might see the price swings and feel the urge to jump out. But the institutional activity we're seeing today suggests a much stronger floor than the public realizes. Looking at the recent stock movement, the volume today has already surpassed 35 million shares, which is significantly higher than its 30-day average. This kind of momentum usually precedes a breakout or a sharp correction, but in this case, the buy-side pressure is holding firm. We've seen this play out with other high-growth names like Tesla stock or Nvidia stock when they were in their early misunderstood phases. Investors on platforms like the Interactive Brokers trading platform are watching the 13.2% short interest closely. With 124 million shares sold short, any positive news on the housing front could trigger a short squeeze that would move this stock far beyond the $6 mark in a matter of days. If you're managing your own portfolio through Schwab Intelligent Portfolios or a Fidelity brokerage account, you need to understand the institutional landscape here. We aren't just seeing speculative retail trades, we are seeing a shift in the quality of buyers. There's a growing consensus among analysts that Opendoor 2.0, as the management calls it, is actually hitting its unit economics targets. Last week's data showed that the October 2025 cohort of homes actually maintained margins even as local prices dipped slightly in certain regions. This proves that their AI-driven pricing isn't just a marketing slogan, it's a functional risk management tool that is finally paying off. Let's talk about the business for a second, because the what is just as important as the how much. Opendoor buys homes directly from sellers who want a certain, fast transaction. They then do light repairs and list them back on the market. In the past, they were too aggressive, buying anything and everything, which led to a massive $1.1 billion net loss in late 2025 due to inventory write-downs. But the Opendoor you see today is different. They've capped their quarterly acquisitions at a more manageable 6,000 homes, focusing on quality over quantity. This disciplined approach is what's driving the current price action. The tension here lies in the gap between the company's past failures and its current execution. Many people still remember the massive losses and the fear of bankruptcy that haunted the stock in 2024 and 2025. That's the expectation, that this is a failing business model. The reality is that the company is currently on track to reach adjusted net income profitability by the end of this year. When a company moves from burning cash to making cash, that's usually when the biggest price appreciation happens. If you're looking for investment help or using investing sites to find the next big move, this gap between perception and reality is where you find the most value. Comment below how many shares of Opendoor Technologies you currently hold, or if you're waiting for a specific price target before you buy in. I'm curious to see if the sentiment here matches what we're seeing in the institutional trade data. The macroeconomic pressures are still there, of course. We can't ignore the fact that the housing market is still recovering from a long period of stagnation. However, the capital markets are starting to provide more support. Debt financing is becoming easier to obtain, and that's a direct tailwind for a company that relies on credit lines to buy homes. Whether you're using the Fidelity mobile app or the Robinhood app to trade, you have to look at the cost of capital. As credit spreads tighten, Opendoor's profit per home increases almost automatically. This is a lever that many retail investors completely miss because they're too focused on the daily ticker price. Comparing Opendoor to its peers like Zillow or OfferPad is also enlightening. While Zillow has largely moved away from the heavy lifting of buying and selling homes themselves, Opendoor has doubled down on the operational excellence required to make it work.
It's a classic winner-take-all scenario in the iBuying space. If Opendoor can prove that its model works at a scale of 6,000 homes a quarter, the market will likely reward them with a much higher multiple, similar to what we see with tech-enabled service companies rather than traditional real estate firms. For those of you involved in self-investing or using the SoFi trading platform, keep an eye on the liquidity. Opendoor has been very strategic about its cash position, ensuring they have enough runway to get to that profitability milestone without needing to dilute shareholders further. This was a major concern a year ago, but today that risk seems much lower. When you combine improved unit economics with a stabilizing housing market and a massive short position that could be forced to cover, you have the ingredients for a significant move. The future outlook for Open depends heavily on the next two earnings calls. If they can show consistent growth in their contribution profit, which is basically the money they make on each house after direct costs, the skepticism will continue to melt away. The catalyst to watch is the expansion of their partnership program. They are increasingly working with agents rather than competing against them, which lowers their customer acquisition costs significantly. This is a massive shift in strategy that hasn't been fully priced in by the market yet. Expectations for Opendoor have been bottom of the barrel for a long time. People expected the company to go to zero. The reality is a company that has survived the worst housing market in a generation and come out leaner, smarter, and more focused. They've replaced the buy everything mentality with a data-first approach that is actually starting to show up in the bottom line. This is the difference between a speculative play and a turnaround story. If you're looking for investment help or using investing sites to find the next big move, this gap between perception and reality is where you find the most value. To summarize the situation, Opendoor at $5.51 is a company that the market is finally starting to take seriously again. The intraday movement today is a reflection of that shifting sentiment. We've moved past the fear of collapse and into a phase of operational proof. The gap between what people think Opendoor is, a risky house flipper, and what it actually is, a disciplined, data-driven marketplace, is where the opportunity lies. Institutional buyers are clearly seeing something the general public is still questioning, as evidenced by the high-volume block trades we've seen today. Whether you're using Schwab Intelligent Portfolios for a hands-off approach or you're deep into active investing on the Robinhood trading platform, the lesson here is to look beyond the headlines. The housing market doesn't need to be perfect for Opendoor to succeed. It just needs to be predictable. And for the first time in years, predictability is returning to the market. This is a stock that requires patience and a high tolerance for volatility, but the underlying fundamentals are currently trending in a way we haven't seen since the company first went public. The reality of the situation is that Opendoor has spent the last 18 months building a fortress around its balance sheet, while everyone else was waiting for them to fail. They've refined their AI, tightened their acquisition criteria, and focused on the one thing that matters: profitability per home. As we move into the second half of 2026, the contrast between the old Opendoor and the new version will become even more apparent. Keep your eyes on the volume and the institutional inflow, as those are the most reliable indicators of where this stock is headed next. We've seen how the market narrative can be slow to catch up with operational reality. For years, the story was that iBuying was a flawed concept that couldn't survive high interest rates. But as Opendoor continues to hit its targets and move toward positive net income, that story is changing. The stock is no longer just a proxy for the housing market. It's a bet on a specific technology and a specific management team's ability to execute under pressure. That shift in perception is what drives long-term value. And based on today's price action, that shift is well underway. As you navigate your online investing journey, remember that the most profitable moves often happen when you're willing to look at the data that everyone else is ignoring. Today's price action in Open is a perfect example of that. It's not just a 5% gain, it's a signal of confidence in a model that many had left for dead. Whether you're holding for the long term or looking for a short-term swing, the dynamics at play here are some of the most interesting in the current market. Stay focused on the reality of the numbers, and don't let the noise of past expectations cloud your judgment of where the company is actually going. The authority in this space belongs to those who can distinguish between a temporary price spike and a fundamental shift in business trajectory. With Opendoor, we are seeing the latter. The company is proving that it can operate in a high-rate environment, and that realization is what will eventually close the gap between the current share price and the company's true potential. As the trading session continues, watch for whether that $5.50 level holds as support. If it does, we might be looking at the start of a much larger trend.